We had a listener question from Veronica in Duluth. She wants to know the difference between a HELOC and a home equity loan. And a HELOC stands for Home Equity Line of Credit. HELOC. Home Equity Line of Credit. And a home equity loan is just that, a home equity loan. And Veronica wants to know, are they essentially the same thing? And the answer is yes. Now, remember, terminology can be, interchanged. And so people could be talking about home equity loans when they really mean home equity line of credit, and that would make perfectly good sense. But let's just say, for example, you had a $400,000 house and you only owed $200,000. A local bank, now these are not made by the big mortgage companies, only local and regional banks actually make these kind of loans because they're not federally insured home mortgages. But let's just say you had $200,000 worth of equity and the lender would loan you up to 80%. So they would loan you up to $320,000. Since your home was worth $400, 80% is $320. $320 is $120,000 more than what you owe on the home. So basically, you are getting a loan from the bank that is secured by your equity in a home up to a certain point. Generally, they don't like to go over 80% of the value. So in Veronica's situation, if her home was $400, she owed $200, she could borrow another $120,000 and stay at that 80% loan to value. That means what is the value of the loan compared to the value of the home, the market value of the home. She could borrow up to $320,000. A home equity line of credit gives you something that is similar to a credit card. You'll have a minimum monthly payment. You can pay whatever you want every month, and you can actually borrow money. So in Veronica's case, she might have a $120,000 line of credit that she never uses. She just wants to have it there. She wants to make sure she's got the cash available. It either can have a current balance or it can have no balance whatsoever. If you don't have a balance on a home equity line of credit loan, you typically will pay some annual fees. I know I have in the past. And the difference is a home equity loan is generally a fixed loan with fixed payments that are paid back over time. So in the same example where Veronica could pull out $120,000 worth of equity, they would take that home equity, the home equity loan, and for example, amortize it over 10 years. So you would borrow a fixed amount of money, and then you would pay that money back at fixed amounts every single month. You could pay more and decrease your principal, but you couldn't pay less. And most home equity lines of credit, you can pay just interest only. There is no amortization of the principal over time. It gives you flexibility. There's also some people who say you can use home equity lines of credit to pay all your bills and save a ton of money. That's too much for me. It's too confusing. I don't quite understand it.